Hello and welcome back to the Research Analyst series of NISM. So in this video, we will be covering the next topic, that is uh, terminology in equity and debt markets. That is chapter number 3. So the learning objectives of this chapter is terminology used in equity markets, terminology used in debt markets, and different types of bonds and their features. Security markets enable investors to deploy their surplus funds in investment instruments that are predefined for their futures issued under regulatory supervision, and in most cases liquid in the secondary markets. There are two core types of securities that are used by seekers of capital from investors: equity and debt. When a business needs capital to fund its operations and expansion, it makes a choice between these two types of securities. Equity capital is available for the company to use as long as it is needed. Debt capital will have to be returned after the specified time. Equity investors do not enjoy any fixed return or return of principal invested. Debt investors earn a fixed rate of interest and return of principal at maturity. Equity investors are owners of the business. Debt investors are lenders to the business. Equity investors participate in the management of the business, and debt investors do not. Residual profits of the business belong to the equity investors. Debt investors' claim is restricted to the periodic fixed coupons and principal repayment on maturity. Due to these fundamental differences in equity and debt securities, they are seen as two distinct asset classes between which investors make a choice. Equity represents a risky long-term growth-oriented investment that can show a high volatility in performance depending on how the underlying business is performing. There is no assurance of return to the equity investor. Since the value of the investment is bound to fluctuate, debt represents a relatively lower risk, steady income-oriented investment. It generates a steady rate of return provided the business remains profitable and does not default on its payments. Since all residual benefits of deploying capital in a profitable business go to the equity investor, the return to equity investor is likely to be higher than that of debt investors. For example, if a business borrows funds at 12% and is able to earn a return of 14% on the assets created by such borrowing, the debt investor receives only 12% as promised, but the excess 2% earned by the assets benefits the equity investor. The downside also hurts the equity investor, who may not earn anything if the return is lower than the borrowing cost and if the business is failing. Choosing between the equity and debt is a trade-off. Investors desiring lower risk and willing to accept a lower stable return choose debt. If they seek a higher return, they may not be able to earn it without taking on the additional risk of the equity investment. Most investors tend to allocate their capital between these two choices, depending on their expected return, their investing time period, their risk appetite, and their needs. This chapter captures the features of the equity and debt instruments along with other instruments which borrow features both from equity and debt. Next topic is terminology in equity market. First terminology is face value, that is FP. The nominal price of a share is known as its face value. The equity capital of the company is calculated by multiplying the number of shares issued by its face value. For example, in a case a company has issued 1 lakh shares with a face value of rupees 10, then the equity capital of the company would be rupees 10 lakh, or that means 1 lakh into multiplied by 10. Shares may be issued to the investors at the face value or a price higher, that is premium, than the face value, or a price lower, that is discount, than the face value. The face value of a company's share does not usually change unless the company decides to split or consolidate its shares. In such cases, the face value of company's shares would reduce in case of a split. or increase. In case of consolidation, for example, if an investor holds one share of 10 rupees FE and the company decides to split its one share into five, then the new face value of its share would be rupees 2, and the investor would hold five such shares. The face value of share is important for calculating the dividend payable on a share. When dividend is mentioned as a percentage, that percentage is reckoned with regard to the face value. For example, if a company with a face value of rupees 10 declares 30% dividend, it means a dividend of rupees 3 per share. However, if a company with face value of rupees 10 declares 30% dividend, it means a dividend of rupees 0.60 per share. Next terminology is book value. We will cover this one in the next video. That's it for now. Thank you.